Alright guys, so welcome to this teaching. Today is day 29, I think, or 20, yeah. Today is day 28 of this teaching, sorry. And we have been on for some time now. Please, if you have not gone through the previous video, do also go through those videos before coming over here so that I have a better understanding of what we are doing. Alright, so the teachings are all available on one single playlist, right? So welcome to go through it, and welcome to day 29, right? And don't forget that our profit blueprint is still at a pre-order price, 50% off. If you want to get the blueprint, use the link in the description. And if you want to join our paid mentorship as well, our annual paid mentorship, use the link in the description as well. All right, so let's go into the business of the day. All right, so today's topic will not be so long or lengthy. It's a very simple topic, which is called seasonalities, right? So seasonality is a very important topic, something that you have to understand. It's part of your sentimental analysis, right? It's part of sentiment, right? It's not really a chart thing. It's just sentiment from observing people for the past years. Right? So seasonalities are seasonal tendencies, right? So when we refer to seasonalities, we're referring to frequent happenings that occur within a given period, right? For instance, now in your local markets, when we are approaching a festive period like the Christmas period in December or the Salah, if you're a Muslim, we tend to see people buying more of livestock, cow, goat, chicken, all those edible stuff. See people buying rice, see people buying tomatoes, see people buying clothes, drinks. All that is happening is what we refer to as what seasonalities. So they're approaching the festive season or the festive period, and then you see people tend to buy those particular kind of things, right? When we are approaching the Easter as well, we see people tend to buy um eateries, cook, foodstuffs to cook for the Easter to celebrate, Easter period and all of that, right? So those are occurrences that happen. And then when we happen to stumble upon WAR events, like it's currently going on between two nations. So whenever we have those kind of events, right, we tend to see certain occurrences. For instance, we see DXY tend to be bullish during those WAR events. I would tend to see gold go bullish as well because people are panicking, right? People are investing in the currencies they feel or the things they feel is going to not lose value. So they tend to run to gold, they tend to run to USD and all of that, right? Because of what? The WAR events, right? So now seasonalities can help you to know what the market is going to do. So for instance, now at a particular month, there's a particular thing you should expect on a particular pair. At a particular month, there's certain things you should expect at a particular pair. Right? That is basically what you're doing in seasonalities. You're using the frequent happenings to anticipate what should currently happen. And note this, seasonalities are not 100% immediate. So the fact that you're in a bullish seasonality doesn't mean you should go and start buying dollar immediately, right? Because there can be retracements which your account may not be able to hold, right? So seasonality just gives you what the overall picture of what to expect. Then you cannot combine market structure and your chart to anticipate what the market is going to do. All right. So now let's start with gold, right? So let's start with gold. For instance, now let's look at seasonality, right? So if you come to this chart, equityclock.com/seasonality, you're going to have this chart, right? This is a seasonality chart, and then you come and you click on charts. You say you're able to see the seasonalities, right? So you can see indices, you can see the Dow Jones, you can see the Nasdaq, you can see the SP 500. These are all indices, right? Note that some of these platforms are not free. Like, as some of these things are not free, you have to pay to access some of them. But we'll be going to the ones that are free for now. So there are a lot of them that are free. So commodities, you can see cocoa futures, coffee. If you take commodities, you can see live cattle. You know that live cattle will obviously be bullish around December. You can see lean hog, that is pigs. You can see natural gas futures. You can see soybeans. You can see rice. You can see sugar. You can see all of them. These are all commodities which you can actually anticipate. Then you can see index futures. You can see US dollar. You can see S&P 500. You can see Nikkei. can see Nasdaq, they can see the interest futures. These are the interest rates, the interest rates. So interest is interest T notes, right? The interest, the T notes treasury bonds. You can see then you can see the currency futures. You can see Euro dollar, Japanese yen, what the Japanese yen do. You can see foreign the currency pairs. Future currency futures and Forex are the same. So it's the same thing you see on these two charts. So the AUD futures will be the same thing with the Australian Forex. These two are the same, right? So this is where you see what happens on the Mexican peso futures and all others. So let's start with gold. So if you come to commodities now, you'll see gold futures here, right? You want to see gold seasonalities. Now, for gold, this is the 20-year study period. This is 20 years. You can see the percentage increase, and then you can see the month. You can see January up to December. Then you can see the relativity to SP 500. And so whenever gold is bullish, we tend to see a decline in SP 500. Then you can see the monthly averages here. So these are the monthly averages. You can see January, February. This is over the last 20 years. That means over the last 20 years, we tend to see the highest gain in gold between December and January. So gold moves from 60 to 65 in January, between December and January, because of what? The seasonality. So gold tends to be bullish between January and between December and January, right? So gold gets bullish between October and up until January. So gold starts moving up from October and it starts going up until January. So between October and January, we usually see what? A bullish momentum in gold. And over the last 20 years, the maximum return we have seen and the maximum return we usually see happens between that period as well. All right. So you usually see this. So let's go to the rate charts. Let's look at gold. So remember what they said. They said that between October and January, we usually see the highest momentum of bullish for pricing in gold. So you can just simply come to here. Let's look for gold. So where is gold? This is gold. All right. This is good now. All right. So between October and January, we usually see a push up. So let's look for gold. You can see that. So last year, where was October? Okay, this is October here. This was October. Can you see that between October up until January? Can you see that was actually a very bullish momentum? And it even lasted to February. Can you see? Relatively gold was moving upwards. It was bullish between October up until February, right? So let's look at another way. Note that this thing is not automatic. You have to also compare other things like market structure, all those other fun stuff, right? Don't just go and be trading seasonality blindly. Right, look at another one here. Between October, it's October now. It's October and January. Can you see? Although this market was not really so clear, but you can see that it was really a bullish momentum, which happened very well between November and December. You can see that was really very good momentum. Between December and January, it happened finally. So this bullish momentum there. So that is it. You have to also have a consider structure. This market was currently bearish. Why market was breaking lows? So you have to also consider the market structure, not just that we're trading seasonalities blindly, right? Let's look at another one here between October and January as well. So this October here. So between October and January, you can see the bullish momentum that occurred, and then he now dropped a match. Why did he drop a match? Let's see. Maybe there was an event. All right. Okay, March. You can see that between the end of February and March, between end of February and March, actually a drop in good. So that what happened between February and March. You can see that there was actually a drop in good between February and March, just like that chart implies, right? So let's look at the last one, 2019. This is very, very interesting. All right. Between October and January. So looking for October and January. And so this October here, somewhere around there, you can see between October and January, can you see what the heavy push up, and then between February and March, can you see what the drop? So that's exactly what happens. You can take your time to study these things, right? So let's look at another one. Let's look at I've done with good now. Let's look at the dollar index. And knows that when it comes to these seasonalities, you don't just trade seasonalities blindly. You have to also consider what the market structure. What is the market structure currently? Is it bullish? But you don't just go and begin to buy gold because it's a bullish seasonality. Or go and be buying dollar index because it's a bullish seasonality, right? So you have to look at the market from the other components, the market structure, the draw liquidity, all of that. But so between on this particular pair, let's look at it. So gold, dollar index tends to be bearish in December and then becomes bullish between January and February. So we really see was a decline in December and then a bullish pricing between January and February, right? So let's look at that. So over the last 20 years, the highest gain on the highest loss on dollar index happens to be in December. We really see a decline in December, and then between January and February, so was a push. So between the end of December and um, from January to February, we really see was a push up. So between January and February, we really see was a bullish movement, which was preceded by was a December bearish price action, right? So let's look. So remember a decline in December and then a push up in January and February. That was how dollar index tend to trade, right? So let's look at the rate chart and compare this and see if that's actually true. So dollar index now. Remember again that you must look at the structure of the market. Don't just go and trade this thing blindly, right? Don't just trade it blindly. You have to look at the structure of the market to confirm if it's actually true or if it's ready, right? And don't forget that you can get our profit blueprint in the link in the description, with the link in the description, right? All right. So I cannot really talk about a lot of things here because I have to talk about open interest. Because I can't talk about open interest here because of time. So we have discussed all these things now, paid mentorship. All these things have been discussed with longer examples, with bigger, deeper examples. This is just to open your eyes to a lot of things to help you, even if you're not part of the paid group, right? But if you really want to take it a step further, then you have to join the paid group because we have teachings from 2021 up until these days. Long teachings, deep teachings, and all of that. Right? So this is December now. Look at December last year. In December, what did we see in December? A decline. And what happened between January and February? What? A push up. Don't forget what we saw here. Don't forget a decline in December and then what? A push up between January and February, right? So a decline in December happened last year and what? A push this year between January and what? February, right? Let's look at last year as well. This is very beautiful. And let's look at 2020. So what happened there? December, what happened in December? Can see this push down, and then between January and February, what happened? He push up. So consider the structure of the market. Remember, consider structure of the market. Finally, let's look at the last one, which is 2019. Or the last one in 2019. So you can look at other months yourself. Now, this is December now. What did happen in December? It dropped down. And what happened in January, February? What happened? A bullish push up. Right. That's also what we see in dollar index on the so that's what you should see. So remember that dollar index, you can't trade dollar index directly. You have to look at um, the uh, the pair trading. And remember that if dollar index is dropping, that means EU and GU are going up. So if there's a seasonal tendency, for instance, we're approaching December now, if there's a seasonal tendency for dollar to drop in December, that means there's a bullish tendency for EU to rise in December. So EU and GU go opposite with dollar index. So you have to look at these things, look at the seasonal tendencies, and then do your projection. We also have other seasonal tendencies there, which you can go and consult on by your spare time. You can look at these other ones. For instance, I can see the Japanese yen future. So if you trade GJ, you trade EJ, you can go and compare the seasonalities of the yen to the pair you're trading, right? So you do that if you want to really have a better feel for what the market is doing, right? So it's best if you see dollar index bearish and then you see the British pounds bullish on seasonalities. If British pound is bullish on seasonalities and dollar is what? Bearish. That means you will see a very bullish move on GBP USD. So always compare the pairs you're trading and try to anticipate what they should do. All right. So this is the end of today's call. I hope to see you guys in tomorrow's teaching. Have a wonderful day. If you want to join our paid group, use the link in the description. If you want to get our profile blueprint at 50% discount, also use the link in the description. All right. So see you guys tomorrow. Have a wonderful day.